Yeah, I mean, it's definitely in the cards. You know, the producers are very prolific. The Permian is very prolific. We have a lot of gas flowing. We have a huge surplus on a year-on-year basis and relative to the 5-year average. And more importantly, where that surplus is located is in the South Central, right at Henry Hub. And so it's not evenly distributed, it's concentrated right at the hub. And so we have a lot of pressure on the market. Now, we've been burning less coal and burning more gas, trying to soak up that extra gas. We've been transporting it out to the Midwest and backing off Canadian gas. But is that enough? And we'll soon find out as we go into the shoulder season where there's not that much demand.
I've got to ask you, how much of that is also to do with the fact that ISMs have been incredibly weak? And if we see further deterioration, does that just build to the case that we are going to see, obviously, the need for less gas use, irrespective of the weather conditions as well?
I mean, what we're seeing is like increased renewables, increased wind, increased concern about industrial demand, and then also the maintenance cycle for LNG export plants. So when you look at like what is most likely to happen or the distribution of events that could happen, they're lean bearish, not bullish as we head into the summer.
I do want to get your thoughts in. I mean, you're calling for $120 a barrel on crude, Bill. We just had a guest earlier on talk about $140 per barrel. Would the geopolitics support that sort of move?
I don't know if the geopolitics have a choice. I think before the cut, it was bullish. I think there's a lot of concern by global macro about a recession happening, a global recession, interest rates rising. But in a normal economic tightening cycle, crude oil demand stays flat or grows. It doesn't collapse. I think people are looking at like the 9/11, COVID, the housing crisis. Those aren't normal monetary cycle tightenings or recessions. Those are extraordinary anomalous events. And so when you look at the normal belt tightening cycles, crude oil demand grows. And we just haven't had enough capital investment in crude oil. And a friend of mine, John Arnold, pointed to a chart where the growth of shale oil has dramatically decelerated. And so OPEC is in the driver's seat with this cut. I also noticed that you guys talked about the tightening spread between Brent and WTI, but just remember the specs have changed on Brent such that you can deliver WTI into the Brent contract. So I'd expect that to tighten. But overall, the market has been bullish. There is notional demand growth year over year, and we haven't had enough investment into oil production.